if I've got 15 banks in Europe melting down, I don't have a clue where that debt sits, or what they're doing to fix it, or whether people are going to start withdrawing from the EU, and one night the market's up 500 points, the next day it's down 400 points. You can't do, you just can't do deals under those circumstances. You can't put collars on deals. You can't negotiate decent breakup fees. People don't know whether to go left or right. Your shareholders will go berserk if you go buy a company at $14, the next day it's $6. I mean, it puts such a damper on people wanting to move, and the more and more investors you talk to are just that. They're paralyzed.
David, how do you, Don has raised a great point here. How do you put values on companies when one day the value is X and the next day it may be X minus or X plus 8–10%?
Well, Tyler, you know, the thing that I thought you were going to start to see a real renaissance and a boom in takeover activity, because all of the pieces are in place to really see the right environment for M&A. In a low growth environment where there's not a lot of growth, companies are looking at combinations and cost reductions to really drive earnings. And these businesses today have delevered, and so corporate America's got a lot of cash to really step into the game, but it just hasn't happened. And I think part of it is that uncertainty that if your PE is trading significantly below the target and you've got to pay a premium, it's hard for boards to really jump on and say, we're comfortable with this acquisition. But the pieces are in place to see that happen. And so, you know, when people look to your question about the valuation, you're really looking at the underlying fundamentals. What's the business earning, and what can it earn under the ownership of the new owner? And so I think that people can still figure out what the intrinsic value is, but there's certainly tremendous volatility in the day-to-day swings in the market.
When you've got the uncertainties about where the debts are, and you may have meltdowns in the banking system in Europe and who knows where else, where that might reverberate, what does that do to the willingness of banks to participate in these deals and to help finance them?
Well, look, and clearly, we think lending, particularly for the investment grade space, is incredibly strong. I mean, Goodrich, which I was involved in, United Technologies, a $15 billion bridge, it's publicly reported. Greg Hayes, the United Technologies CFO, got $100 billion in offers in 24 or 36 hours to finance. So parts of this market space, again, if you're investment grade, pretty strong investment grade, money is available at historically very attractive rates. In terms of the bank's willingness to lend, look, I think we've all gotten a lot smarter, you know, given the history that went on, you know, given the financial crisis, but there's clearly money available. I mean, these big deals aren't getting, I mean, the market is a cash market. 70% of transactions year to date are cash, all cash. So clearly between cash on the books and between, you know, what's available, you know, from the banks, I think it's still going on. Is it getting, you know, parts of, you know, in Europe, clearly what's gone on, but, you know, what we're seeing, the European banks still also lend. So, I mean, I get the arguments as to why it shouldn't happen, but at least up to this point, you know, from standpoint of, you know, where I sit, you know, there's plenty of capital still available.
And a lot of the deals can be done largely in cash without the need for a lot of
well, yeah, true, but some people, you know, choose to draw down on lines. Remember, you got a lot of trapped cash overseas, so sometimes you look at cash balances on the books, and it's not available to do a North American transaction.